Some of the hottest stocks in market history became scorching because the crowd finally recognized the buildup that had been forming beneath the surface for an extended period. Tesla rode the electric vehicle revolution with strong conviction as production ramps and battery breakthroughs pushed the share price higher on consistent delivery beats quarter after quarter. The company transformed from a niche automaker into a technology powerhouse by scaling manufacturing at a pace few thought possible, with each earnings report revealing higher margins and expanding global reach that sent institutional money pouring in deep. The narrative around sustainable energy and autonomous driving kept momentum pulsing higher and higher, creating a self-reinforcing cycle where every positive development added to the upward pressure. Volume would surge on news of new factory openings or regulatory approvals, confirming that the interest was broad and sustained rather than fleeting. Technical breakouts occurred repeatedly as the stock penetrated resistance levels that once seemed insurmountable, with RSI readings climbing into overbought territory only to reset during healthy pullbacks before thrusting higher again. This combination of real business progress and market sentiment created the kind of heat that turned Tesla into one of the most watched and rewarding investments of the past decade, delivering returns that compounded dramatically for those who held through the volatility. NVIDIA captured the same intensity during the artificial intelligence boom as demand for advanced chips exploded and earnings repeatedly surprised to the upside. The company had been quietly building expertise in graphics processing units for years, but the sudden surge in AI applications created a catalyst that made the stock feel irresistibly hot almost overnight. Data center spending poured in deeper than anticipated, with hyperscale customers committing to massive orders that expanded margins and revenue at rates that left analysts breathless. The share price rode powerful upward legs into triple-digit gains as each quarterly report reinforced the narrative of insatiable demand. Volume spikes accompanied every major announcement, showing institutional conviction that refused to fade even during temporary pullbacks. Technical charts showed the price hugging moving averages before breaking out with conviction, while short interest created additional squeeze pressure that amplified the moves. NVIDIA exemplified how a secular trend combined with execution excellence can turn a stock into a market leader that throbs with potential for years, rewarding early believers with returns that far outpaced the broader indices. Amazon, in its early growth phase, created a similar effect through e-commerce dominance that built an ever-widening moat around its business. The company started as an online bookstore, but expanded relentlessly into general retail, cloud computing, and logistics, each new segment adding layers of revenue and profitability that the market eventually recognized with increasing enthusiasm. Once investors grasped the scale of the opportunity and the competitive advantages Amazon had constructed, shares broke out decisively and began a long period of compounding returns. Institutional ownership swelled as funds slid into deep positions, volume expanded on positive news flow, and the stock demonstrated long, strong legs by recovering from every dip with renewed vigor. Earnings growth accelerated as the AWS cloud division became a profit engine, creating fundamental support that justified ever higher valuations. The narrative of Amazon as the everything store combined with tangible business metrics to produce the kind of sustained heat that turned patient investors into significant wealth over time. What made these stocks truly hot was perfect timing combined with undeniable growth catalysts, innovation that created scarcity, and sentiment that built pressure until the breakout became unstoppable. History repeats the pattern across many names. Quiet accumulation by sophisticated investors, followed by sudden, powerful momentum once the catalyst arrives. Apple, during the smartphone era, followed a comparable trajectory as the iPhone redefined consumer technology and created an ecosystem that generated recurring revenue through services and accessories. The stock built pressure for years as margins expanded and global adoption accelerated, eventually thrusting higher on technical breakouts that coincided with record earnings. Volume would surge on product launch days, confirming broad participation, while short squeezes added extra thrust during key periods. Netflix transformed the entertainment industry by pioneering streaming, building a subscriber base that grew exponentially and created a content moat that competitors struggled to penetrate. Each earnings beat sent the shares pulsing higher, with institutional money flowing in deep as the market recognized the shift from linear television to on-demand viewing. The pattern is consistent. A visionary idea meets execution. Fundamentals improve dramatically, technicals confirm the move, and sentiment turns euphoric, creating the throbbing advance that defines hot stocks. Other examples reinforce the lesson. During the dot-com era, companies like Cisco Systems rode the internet infrastructure boom with similar dynamics, as demand for networking equipment exploded and the stock delivered extraordinary gains before the eventual correction. More recently, certain biotechnology names have become scorching on the back of breakthrough drug approvals, where a single positive clinical trial result can create explosive volume and price action that rewards those positioned ahead of the news. The common thread across all these cases is the alignment of innovation, execution, and market recognition after a period of underappreciated buildup. Quiet accumulation gives way to public enthusiasm, volume confirms the shift, technical breakouts provide entry signals, and fundamentals justify the higher valuations. Short interest often plays a supporting role by creating squeeze conditions that accelerate the upward release. Investors who study these historical cases learn to look for the same ingredients in current names: a compelling long-term story, improving financial metrics, institutional accumulation, and technical setups that show pressure building rather than dissipating. The market environment also influences how hot a stock can become. In periods of easy liquidity and low interest rates, growth names tend to heat up more readily because capital flows freely toward future potential rather than current yield. Bull markets amplify the effect by creating a rising tide that lifts innovative companies higher and faster. Conversely, in risk-off environments, the hottest stocks may take longer to develop their momentum, but once the catalyst hits, they can still deliver powerful relative performance. Understanding these macro influences helps place individual stock moves in context without diminishing the importance of company-specific factors. Across decades, the pattern holds. The stocks that become legends do so by building pressure beneath the surface until the market can no longer ignore the heat. Tesla, NVIDIA, Amazon, Apple, and countless others demonstrate that when timing, innovation, execution, and sentiment align, the result is a sustained advance that feels magnetic and rewarding. History provides the blueprint, showing that the hottest stocks are not accidents, but the natural outcome of forces that investors can learn to recognize and position for ahead of time.